Hi everyone, I'm excited to share our recording from our short-term rentals presentation that we did last month. So this is a really good overview for those of you who want to learn more about this tax strategy about short-term rentals. So this gives you a clear framework and how to dive in. So hope you enjoy watching.
I'm Michelle Stricklin. There we go. All right. So our topic today is short-term rentals, and this is just our intro slide, but we're going to talk about, what it is, what are the benefits, why you can get into it, key considerations in terms of like the practical considerations, like how do I even look for, short-term rental, what qualifies. So we'll get into the nitty-gritty as we get through. So why short-term rentals? Well, I'm sure everyone has heard the strategy on TikTok or talked to a neighbor, and it's really a great opportunity to offset your W-2 income. There's not a lot of ways to do it, and this is one of the most beneficial. In terms of, tax advantages, we'll get there in a few minutes, but that's what our presentation is about. We'll also talk about the regulations and the market in terms of like Reno and Tahoe. So what counts as a short-term rental? Well, really it's less than a 7-day stay, so kind of like your Airbnb rentals. There is some allowance for personal use, but keep that to a minimum. And in terms of like what counts as a property, there's no specific type of property that counts as a short-term rental. It's more the usage. All right, so who the strategy works really well for is like high income W-2 earners, so like your doctors, your engineers, tech employees, basically anyone who's like, I have a bunch of cash coming in for my job, how can I offset with losses? Short-term rentals is a wonderful strategy for them, especially married couples, which we will get to. Okay, so what are the tax benefits and how are short-term rentals unique? So first we're going to talk about what is a regular rental and how they're classified and how this is particularly different. So your regular generic long-term rentals, right? You have a house and you rent it out to a family, 1-year lease. That's a regular generic like long-term rental. That is treated as passive income. Passive income does not offset your W-2 income. They're two different buckets, right? So that's passive. And so if you have like a bunch of losses, it'll get built up and it will sit there, which is not what you want. So alternatively, short-term rentals can offset your W-2 income. And the best thing is that they can trigger or they can generate losses and it will reduce your taxable income. So passive and non-passive is the key here. So non-passive is basically what offsets your W-2 income. Passive does not. Passive is the other bucket. The key to being able to get the benefit of this is called material participation, and that's where the IRS comes in. So if you ever get audited and they ask about material participation, you better have a lot of documentation ready to show for it. So the kind of the hurdle for getting short-term rental benefit is you have to document that you are materially participating. And so what that means is you're spending at minimum 500 plus hours, which is a lot, or 100 plus more than anyone else spending time on the property. So say you have rental management, cleaners, other service providers, you better be doing 100 hours more than anyone else. If not, you don't get the benefit. And so there's tracking, documentation, the hours is really important, or else you're going to get a big X and it's going to be passive and you can't offset it. And this is an annual thing. So this is like a pretty onerous burden, but it's every year. So 1 year, say, you have medical bills and you don't have the time, you have a new baby, and you don't make it that year, that's okay. It's not like a 1 year and you miss it. It's an every year analysis. So, say you end up having some free time, 3 years in a row, great, you can get it 3 years in a row. So that's material participation, and that's basically what is going to let you qualify for short-term rentals in terms of the IRS. All right. So common myths. Common myths are, oh, you have a W-2, you're not going to qualify. You're a real estate, or you're not a real estate agent, you're not going to qualify. You have personal use, not going to qualify. So basically, all of those are myths, and what's going to dictate is the hours, the material participation. Basically, if you can prove that you are spending enough time and you meet the less than 7 average day stay, then you can get the benefit of the short-term rentals. All right. And again, the benefit of the short-term rentals is that you're going to get your losses passing through to your income versus kind of sitting in that other bucket. So I had mentioned that married couples is like a wonderful target for this strategy. So with a high income W-2, that person's going to be busy, right? They're working 9 to 5 or probably more in their regular job. How are they going to have time to manage a short-term rental? Well, that's where a spouse will come in, right? And so in the eyes of the IRS, the married couple is one filer, right? Doesn't matter. They don't care, if the spouse is doing the work and then the other one has the W-2. So you can basically say, spouse, you have free time. You take care of the short-term rental. You meet the material participation rules. We can offset my W-2 income. So that's how this works. And then it's based on like a combined, right? Like the IRS isn't going to look at spouse 1, spouse 2, who meets 100 hours or 500 hours. It's on a combined level. Okay, so we're gonna bring this home in an example. So in example 1, we have a single person who is an engineer. He buys a cabin, he has extra income. I'm gonna buy a second property. I'm gonna get some short-term rental benefit. He gets a cost egg in year 1, $150,000 depreciation. The benefit of that is he takes, take 30% of that, about 50,000 of tax loss that you get to use in year 1. Offset against your $200,000 of income. That is a wonderful benefit. There's very few things that will get you that type of benefit, especially on your kind of regular generic W-2 income. So example 2, basically the same information, but this is the couples, right? So this is the married couple. Married couple, spouse A has the job, spouse B has the time to spend managing the short-term rental. So same thing, they get the cost egg, they get the benefit. The spouse spends the time, the other spouse has the income, and then they get to take the benefit of the short-term rental. So this is the power right here of the strategy. So we kind of talked about like high level, the tax implications, right? Being able to meet the short-term rental requirements. But in terms of actually getting a short-term rental, right, there's a lot of considerations like your local market, right? If you're going to invest locally, what are the regulations? What are the risks related to it? Am I going to be managing the property? Do I have an ecosystem of service providers who can help? Are they going to clean? Something happens to the property, who do I talk to? And then of course, don't forget like your regular like mortgage lenders and all of that. Like you are buying a property. So let's go through one more slide, and then I think Brett is going to speak. So when it comes to your short-term rentals, please do your research. Look at what's available in the market, what type of property you're trying to rent, right? You're going to rent like a condo, or you're going to rent a house. There's a lot of considerations. Like, please don't jump into it and thinking like, I want to get tax benefits, let's go buy a property. Definitely do your research, just like you are buying, like your own house, right? Like your primary residence. Obviously run the numbers. I'm sure everyone has heard about, bonus depreciation. That is one of the other benefits, right? When you get your cost egg, you get to take bonus on the non-property piece. So, say you buy a table, costs $30,000, bonus depreciation, you get to expense the $30,000 at the table in year 1. So that's the benefit. All right. I think Brad is going to speak now.
Yeah, so I just wanted to piggyback on that. You guys probably had a lot of questions about all that stuff, so we'll probably just do it.
I had a question.
Yeah.
You mentioned up front about the hours side of things, so like 100 plus hours over someone else, or the 500 hours total. right? And you said, well, you know, if you have if you have a manager, for example, and cleaners. So my question is, what kinds of things are people logging in that situation to get those 100+ hours over what they're doing? Like, what's the strategy? What do you see people actually doing to get that?
Yeah.
Because it's
So I would say,
at some point, like if you've hired a manager and you have the cleaning crew,
yes. What are you actually doing? Exactly.
other than maybe the books.
So good question. I would say like thinking about the property is not going to qualify for hours, right? Worrying about the property. Yes. Yes. Yes.
I spent 8 hours strategizing.
Social media planning is not going to, qualify. So, maybe speaking with the tenant or, actively looking for other properties and researching and maybe comparing for like rental rates and being actively involved. Driving over to your property, right? Like some of those hours can qualify. So especially we get a lot of people right from the Bay. Yes, yes. And sometimes I go through and I'm like, yeah, this doesn't qualify. This doesn't qualify. So I also will like go through and kind of filter through all the what's been documented or like, hey, can you add more details to this so I can make it supportable? Just vetting all of your service providers, like that qualifies as working on your short-term rental, right? So if you're,
That's like a one-time thing. What are the
Yeah.
things that they're doing other than the cleaning and the management?
I mean, if they're like buying stuff for the buildings, they're talking to their service provider for the cost seg and kind of all of those
There's certain
tentacles.
things that managers will do that you can actually do that will balance some of that out, and then you just have to track all the hours. So I think I was actually talking to Patrick about. Patrick is a short-term rental manager, right? And so probably if you have specific questions, I'm really glad he's here because he can answer all of them.
Yes.
But, well, I was just gonna. We'll just get through this and then we'll. Because there's probably gonna be a bunch of questions.
Yes, that is a good
The
question.
process, though, like everybody gets to these ideas, like I'm gonna buy a short-term rental. I'm gonna save $50,000 on my taxes. It's like, well, talk to somebody like Michelle, if you have a CPA or somebody else first, because it may not make sense because you're gonna have an outlay cost of 150 to 200,000 to get a short-term rental started. If you're looking at establishments and regulations, Lake Tahoe has 5 counties in 2 different states, and they all have different. One incorporated city. That there's all different restrictions. There's also a limitation on the number of permits. So even if they allow them, like Foster County allows them, El Dorado County allows them, but they're starting to run out of permits. And so then it's like, how long will it take you to put this into service? So if you 30 days to close, probably another 30 days if there's any repairs at a minimum. And then you gotta put furnishings, then you have to put the ads up, you have to shop the furniture, you have to do an interior designer. You have to have an idea of who you want to rent that out. So when you're looking for properties and things like that. So sorry, Patrick again earlier, and it's like, do you want like bachelor parties that are golfers? Like that could be a niche. You can do that. You can do bachelorette parties. You can do couples with dogs, with kids. You can make it, an arcade kind of thing. So you really have to have some themes, and that's where either an interior designer or a property manager can kind of help with that in the beginning. The other thing, of course, is HOAs. People generally don't like HOAs, but short-term rentals, especially in Tahoe, if you have a condo, they can do really well because they take care of the snow removal. It's like a big one. Any outside maintenance, so you don't have to worry about somebody tripping on a step. That's like the HOA's problem. And because you probably have nosy neighbors, they're also going to keep an eye on the place to see what tenants are doing. So, like, if you're a homeowner, that can be a negative, but having somebody kind of look at your property all the time can also be a positive. If you're, Nancy Tattletale. Sorry, there's nobody named Nancy, but I have a neighbor named Nancy. So she just observes a lot of stuff, and she texts me a lot. But either way,
between Nancy and Karen.
Right. But either way, there's somebody kind of always looking at the property. The other thing is CC&R. So there are some neighborhoods in Reno that don't allow short-term rentals because you're not allowed to run a business out of it, and they're really old. So one of the neighborhoods actually, whether somebody's going to bring this up, it's just good to look at anyways. I think it's out by like Donner Springs or that they don't technically allow businesses to be run. So somebody could come and say, hey, you can't run a short-term rental here. Is somebody going to do that in that older neighborhood? Probably not. But a lot of the new neighborhoods, they do have restrictions on that, even though it's like a $10 a month HOA, things like that. So I think we do have
So
one.
number of HOAs that restrict, like you have to have 6 months or longer.
Yeah, 6 months, some are 30 days. And then condo complexes right now, a question I get a lot, well, what if they change? Most condo complexes have kind of stabilized their HOA rules because COVID was so crazy that they either got rid of them because there's so many owner occupied, or because there were so many short-term rental owners, they kept them. So HOAs are a little bit more stable. In Reno, there's no restrictions right now. I haven't really heard anything talking about it, but they just passed the ADU thing, and most of the ADUs require long-term rentals, so that's something else to consider. Like, oh, do an ADU, make that a short-term rental, but you're not really allowed to do that. So, other things are going to be, we mentioned location, Tahoe versus Reno. Tahoe is going to have a really variable income stream. Shoulder seasons are pretty low for bookings, so you have to lower your average daily rates. Reno is going to be a lot more consistent. There's also a lower barrier to entry, but the other advantage to a short-term rental is that you can use it yourself. And if you talk to your lender, it can be considered a vacation home, so you can get more favorable lending terms. And I know there's a few bankers in here that you can ask about, like Joe. So it's Dan, also bank. And then look at all the numbers that you're gonna have for startup costs. That's like a big one. Like, yeah, you say 50,000, but you're gonna be you might put 50,000 in for repairs, and then you have all the other stuff that goes along with it. So year one may not make sense, but multiple years later, it's because you can take tax benefit every year. So as you ideally earn more and more, you can continually save. Over 3 years. You might save 150,000 in taxes, and then you have a property that appreciates as well. So. We have a software tool that can help you run those numbers. There's a few others out there. Air DNA is probably the most common. B&B Calc is pretty good. It's a lot less expensive. PropStream I believe, is another one that's pretty common. And then I don't know, maybe that's kind of the main ones. There's probably Price Labs. That's it. Yeah. There's a bunch of them out there. And then we also have a software that can help kind of narrow that market down. Last thing on location and ideal guests. Near the universities generally do well. Any kind of population centers tend to do well. But think about other guests that can actually stay there, not just Californians coming to vacation in Tahoe. There are business people that come to stay. There's people that come for conventions.
Traveling nurses is a great one.
Traveling doctors. People working out at Tesla, building the
Yes.
Data centers out there. That can be a pretty big one. Like they might only be in town for 2 weeks, so think about like those kind of things and the type of people that come into Reno. And actually, Edon has some good data on it. If you guys don't know what Edon is, they're having a board meeting. But they have some good data on who comes to Reno, and then the visitor authority. Yeah, it's not called visitors, sorry. The tourism boards around can help you decide on short-term rentals. So I think we have just one more slide, and then key takeaways.
Yeah. Okay.
And then we'll have questions at the end. So, just so we can keep our
on time. So just to kind of bring the points home, so short-term rentals is a wonderful strategy. You obviously need to document, I hope I harped on that enough, to meet the benefit. And the short-term rental benefit is you can offset your W-2 income as a single person or as a married couple where there's more flexibility to meet the hours threshold. But please make sure to plan ahead. I also wanted to point out you can't do a cost seg every year. Like you can't re-roll that every year. So that kind of like huge chunk benefit is really the year that you do it. And then you could take the bonus depreciation on the property or, on the components within the property that you buy, depending on the type of property, right? If you have an ADU, if you have a small 1-bedroom, right, that you're going to rent out to traveling nurses, you're going to have a different benefit than if you have like a whole house that you're renting out. Okay, and this is just about my firm in general. So my business is Meliora Consulting. We are a tax firm based here in Reno. We just get a bunch of STR questions from wealthy individuals, and I was meeting with Brad and kind of prompted this presentation. Please let us know if you have any questions.
And you're taking on new clients?
Yes, I'm taking on new clients. I
It's important.
I
A lot of CPAs, it's like,
Yes.
know, yeah.
It's that time of year where everyone's like, oh crap, taxes. And yeah, extending, there's nothing wrong with extending your taxes. It's not a red flag. It gives you more time for your return and you get fresher eyes from me. So nothing wrong with filing October 14th or April 14th. As long as you pay in an estimate by April 15th, and you're good. I can service clients nationwide, so I practice here, but I can service clients all over the U.S. So if you have like short-term rental in another state, or you have referral in another state, that's great. So
Thank you for watching our presentation on the short-term rental tax strategy. We know there's a lot to the strategy and we wanted to share what we could today. Please work with your qualified CPA on the tax strategy. And at the end, we also have a download. All right, there you go. Take this download and you can use that going forward to help you make the most of the short-term rental tax strategy. Thank you again for your time.